if, in fact, we are seeing what Steve has just laid out in terms of the kind of maybe convergence or divergence in certain parts of the financial markets because of this, what is the Fed going to do, I guess, is the big question.
So, Dom, I think the story Steve laid out is right in terms of the ISM kind of basically coming in and giving people a lot more confidence. Particularly the prices paid looked quite good below 50, but everything was kind of moving in the Fed's direction. And the other thing I would say just on your whole oil discussion is let's not get too caught up in the front contract. If we look at, the end of December of 2024, oil's only up about $1.50 today. So I think this is probably a shorter term spike. At least the market is telling you that. And remember, the Fed looks at this as a very long-term story. They're not thinking about inflation over the next month or the next 2 months. They're thinking about it over the next 2, 3, 4 quarters and years. And one of the great pieces of news that came out last week even was the University of Michigan survey, which I'm sure Steve talked about last week, showing the one-year inflation expectations down at levels we haven't seen since April of 2021 when inflation first started to surge, and the long-term inflation never went up. So again, I think there's some good news for the Fed. This oil story is definitely going to complicate things. I would say the most interesting thing on the Fed, Dom, at the moment is they sort of pulled back from the 50 because of SVB. And a lot of people are looking at SVB and kind of going, well, wait a minute, maybe that wasn't nearly as important as we thought it was. It was much more about some bad regulation and some bad investment committee decisions at one very large bank, but it's not an endemic or systemic issue. And that, I think, is going to be an interesting debate this time around at the Fed meeting.
Steve, it's an excellent point here. It wasn't that long ago that you and I were both on together talking about how this could be one of those, in fact, effective interest rate hikes. The global banking crisis, the failure of Silicon Valley Bank, has it done some of the work for the Fed for it? But it seems like nobody's really talking about the contagion effect of regional banks as much as they were just 1 to 2 weeks ago. So is that getting less complicated for the Fed?
No, I'm a little traumatized, I have to admit, Dom, by previous experience in that I'm always a little afraid to sound the all clear because these things have a way of operating like a wave that comes by you and then it kind of hits you on the backside. So I'm a little behind the market in saying everything is okay. But you are right that the last week or so, it looks like things are more quiet. The recent Fed report showing that the flow out of the banks is less than it had been. The takedown of lending at the Fed is lower than it had been. But I'll tell you who's talking about this is not so much in a sense of systemic risk as much as the knock-on effect of credit tightening. We did our CNBC Rapid Update looking at GDP, and what you see is this impact in the quarters of the second half of the year, where the first half looks okay, and it's the second half, Dom, where we're showing these negative quarterly numbers. You can see that they were looking for modestly positive or just barely positive. Now it's pretty solidly negative. And a lot of the commentary I'm reading from forecasters, Dom, is because of the potential knock-on effect of credit tightening, not systemic risk.
All right, so credit tightening is one thing. David, we'll give the final word to you here. This is something where the Fed, yes, has to take it into account. Has it changed your forecasts about when and where, if and when a recession were to happen here in the United States? And if so, how deep does it go?
Again, Dom, I think the oil story, while interesting and definitely will get the Fed's attention and probably at the margin, has their inflation radars a little heightened. I think the fact that the back month contracts haven't moved that much, you really, as I think Sully pointed out, you've seen things like gas go the other way. I think they're going to take a little consolation from that, and it's not going to play as much into the calculus as you would have thought Sunday night when everything kind of ripped up and we were moving 10 or 15 basis points higher in those January Fed funds contracts that Steve was showing earlier. So I think it's it was a little bit of an overreaction, and the ISM kind of took it all out. And I think the bigger story is much more what Steve and I were just discussing is how big and how important is this credit tightening? And the market's very divided on that. And we'll learn a lot more about it as time goes on.